The CME Fed Watch tool is currently pricing in a significant chance of a rate cut by June only, pushing it back from March. Now, do you think this is a policy error to keep rates higher for longer, Sam?
I think it has the potential to be a policy error. Yes, I think so far the economy has held up, remarkably well in the face of such big rate hikes that they've had over the last 2 or 3 years. And so I think if they kind of follow the view that the only reason they should cut is if the economy slows down a lot, that's a mistake. I think what they should focus on is inflation, not whether the unemployment rate goes up enough or the economy slows down enough.
In this episode, we're joined by Sam Burns, Chief Strategist at Mill Street Research, and we'll be talking about the latest economic data and whether or not we're going to get a soft landing or hard landing and what will happen to the markets for the remainder of the year. First, a shout out from our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%. If you're over 18 and you want to open a new account with cash or roll over an existing account, click on itrust.capital/David in the link down below to learn more and get started. With Bitcoin's astronomical rise over the last month and two, an IRA may be the safe way to park your Bitcoin. Check it out. Welcome back, Sam.
Thanks for having me on again, David.
You've been pretty much correct all throughout 2023. Hopefully 2024 will bring you as much luck. So far, your research has been spot on again. In the first 6 weeks of the year, markets have been bullish as you have been predicted, or as you have predicted. But you told me offline that we are already in a soft landing. And I'd just like you to clarify that for the audience, because I think people have different definitions of what a soft landing is and what it may look like.
Oh, sure. Yeah, no, it's been a big topic, and I get, different feedback from different people and clients and things, and read a lot of things about it. But in my mind, it's basically that inflation was high and the economy was arguably, sort of too strong for a little while in the last year or two. And that's been corrected, meaning inflation has come down, the economy has stabilized. We did not have a recession, and unemployment did not have to go up. The main thing about landings and things is the assumption that to bring inflation down, unemployment has to go up. That's been the thing that the Fed and a lot of people have assumed for decades. And so if you can get the economy to kind of slow but not stop, and inflation to come down without having to have unemployment go up a lot, that's a soft landing. And that's what we've seen. Unemployment is still quite low by many metrics, and inflation is already very close to the Fed's target, particularly if you account for the housing component, the way it's measured in the US data. So in my mind, the soft landing is already here. We're getting pretty good 2 to 3% growth, real growth, and inflation is coming down rapidly. So I think, to me, that's a soft landing.
Okay. And a soft landing, just to clarify for some people, doesn't mean no recession at all. It's a slowdown, correct? Or am I wrong here?
Right. Well, the economy slowed from kind of where it was, in 22, 23, but has never went into recession, and is back to kind of what we call a normal rate of growth, meaning not too high, not too low, kind of in the range that it should be. So that's the kind of, coming from kind of what might have been an overheated economy for a little while, has come back down to a more normal economy without having to go through a recession first. And that's what we've managed to do so far.
What's the difference between no landing and soft landing?
No landing would be that inflation stays high, essentially, or stays elevated above target, and the economy is still going. So basically, if the economy stays fairly hot and inflation stays hot, then you would just have no landing. You wouldn't have come down. Whereas the hard landing would be inflation comes down, but at the expense of having a recession and a lot of unemployment.
Okay, I understand. Let's talk about your views in the markets now. So the S&P 500 has continued to go higher. The Magnificent Seven stocks have all, except Tesla, but the other six, I guess, have all continued to grind higher, pushing up the S&P 500. Interestingly, the Russell 2000 has not outperformed the large caps yet this year. But let's talk about the large caps first. The Russell's been trading range bound. The large caps, do you continue to see, or do you think that the S&P and other large indices like the NASDAQ will continue to see new highs being pushed throughout the year, Sam?
I think it'll generally be an up year. And I think that for now, certainly, and for a while, I've been in favor of large caps over small caps, kind of from a cyclical basis, meaning that usually small caps tend to outperform coming out of a recession or a trough in the market after things have been bad and starting to get better. That's usually when the small caps really get the biggest kind of bang for the buck. I think we're not anywhere near that now. The market's up a lot, earnings are up. We're kind of getting to mid or later cycle conditions rather than early cycle conditions, and so that's usually when you favor large caps, and so that's what we're seeing. I think and earnings have been much stronger for large caps, so there is kind of a fundamental underlying driver for that. If you look at the earnings for the S&P 500 versus say the S&P 600 or the Russell 2000, there's a big gap now in terms of their growth rates recently, and so and even outside of the Magnificent Seven, that's generally been true. So there is a fundamental reason for it. I think that'll continue for a while. I think once the Fed does actually start to cut rates, sometime middle of the year maybe, then maybe small caps will have a little more of a tailwind or at least a chance to outperform. But until then, they're probably going to still struggle to beat the large caps.
Speaking of a recession, we'll come back to the markets in just a bit. Speaking of recession versus no recession, the leading economic index has dropped 0.4% last month. From the conference board. It's been dropping every single month since March 2022, which is a 22nd straight month in a row. Yet no recession still. Why is that?
Yeah, no, it's certainly a case where the leading index there has been just not a good signal. And I think that's partly because the COVID cycle we've had since 2020 has been so unusual and
Yes.
the extremes have been so high. Some of the components of that leading index are based on surveys and things, consumer sentiment surveys or the ISM survey, as well as things like the yield curve. And those have all been essentially one way or another misleading indicators. They haven't behaved the same way this cycle as they have in past cycles. And so it's really given you kind of a distorted view of where you are in the cycle or how strong the economy actually is. So there's a number of different indicators that have done that, but the LAIs kind of put a lot of them together. And so one of the things I've been telling clients for a while now is, don't focus on the LAIs and some of those indicators that are in it, because there's a reason why they're not going to behave the same way. And so one of them is fiscal policy, and the other is the whipsaw, the bullwhip effects from COVID are still kind of going through the economy, and surveys don't pick that up well.
Are there any indicators that you would look for that you think would be, I guess, more accurate?
Well, mostly what I look at is, the trend in corporate earnings estimates. So what are analysts doing with their forecasts for earnings over the next 12 months? Are they kind of raising them or lowering them, and what kind of stocks and where? So that's kind of kept me in favor of, that say that earnings aren't looking too bad. They're actually looking pretty good, and that tech related areas and financials have been doing better lately. Some industrials, the defensive sectors have not done very well, and commodity sectors. So that's all kind of a backdrop that tells me that the economy's doing fairly well, but it's more the growth side of the economy and the part that's benefiting from fiscal policy. And so in fact, if the federal deficit to GDP ratio, something like that is a good measure to show how much kind of fiscal support the economy is getting, and it's still relatively high, not as high as it was, but still supportive. That's one of the indicators that I look at a lot from a kind of a policy backdrop. And then now you've got the Fed talking about rate cuts coming this year, and that's helped and kind of improve sentiment and keep people thinking about that the monetary headwinds will kind of start to slow down this year.
Talking about the Fed now. So the in the last meeting minutes that were released recently, it showed only two participants in the FOMC raised concerns about the overly restrictive stance of monetary policy. In other words, most participants actually want to keep rates high for at least a longer period of time. The CME Fed Watch tool is currently pricing in a significant chance of a rate cut by June only, pushing it back from March. Now, most participants noted the risks of moving too quickly to ease the stance of policy was in the meeting minutes. Do you think this is a policy error to keep rates higher for longer, Sam?
I think it has the potential to be a policy error. Yes, I think so far the economy has held up, remarkably well in the face of such big rate hikes that they've had over the last 2 or 3 years. And so I think if they kind of follow the view that the only reason they should cut is if the economy slows down a lot, that's a mistake. I think what they should focus on is inflation, not whether the unemployment rate goes up enough or the economy slows down enough. And I think that's what they're looking at right now, saying the economy is still doing pretty well, and therefore policy isn't tight. In my view, policy is tight if the rate is policy rate is far above inflation, and that is. So I think policy is tight, and I think they're kind of going back and forth between the kind of old Phillips curve view that unemployment has to go up in order for inflation to come down. That those two things are linked. Whereas most of the data over the last few decades shows that it's not. You don't have to have higher unemployment to make inflation go down. And in fact, the late 90s or mid to late 90s in 1995, they did rate cuts, and there was no crisis, no recession, and that was kind of the last real soft landing. And you still had inflation, going down, and you had the markets and earnings doing very well. So I think they're looking at that and saying, well, maybe rates don't have to come down very much, but they are tight. And so if fiscal policy is not supportive or productivity slows down, then you would have a problem with rates that tight.
It says here the participants noted that there are risks to moving too quickly. What are these risks that they're referring to?
Oh, moving too quickly to cut.
Yeah, to cut.
Again, it's the view that if they cut rates, then that going to make inflation go back up again. They're going to, see inflation that's been coming down, it's going to turn back up. And I really don't see that happening. I don't think if they cut rates 50 basis points or 100 basis points, that by itself is not going to make inflation go back up. But they think that it might, because again, that's been the long-standing view that they have, is that lower rates cause inflation and higher rates reduce inflation.
Sure.
And that's not really true. It hasn't been the true for a while, and certainly not now. So,
sorry, it hasn't been true?
No, I mean, if you remember, we had zero rates for years and inflation didn't go up.
Right.
So that doesn't make it go up. And higher rates, it can make the inflation go down only by kind of being so high that it produces a recession, which is not what you want. And so I think there's a medium sort of stance in there in between there, where policy should be in line with underlying growth of the economy. And I think right now policy is probably pretty tight, but the economy is doing fairly well, so it can handle it. The risk to me is that they stay tight too long. They're thinking that if they cut too soon, inflation goes back up, then they have to raise rates again, and they don't want to have to reverse themselves because it looks bad. But I don't really think that's how it works. I don't think small movements in interest rates really affect the economy as directly as they think it does.
What if just hypothetically suppose that inflation never returns to the 2% target? So the last headline CPI, I know the Fed looks at core PC, but let's just take the headline CPI as a rough gauge. The last headline CPI reading was 3.1%. Suppose CPI stays above 3% for an extended period of time. Would you say then that the Fed would just not move rates simply because inflation is sticky? Is that like their policy then?
Yeah, I mean, my guess is the way that they think would be that if the reported inflation rate doesn't come down closer to their 2.5% target, that they would feel obligated to keep rates, relatively high.
Yeah.
Because they think that that's what would cause inflation to go down. I think inflation will continue to kind of trend lower. It's going to be still bumpy because the way the numbers are bumpy. But yeah, if that did happen, then I think they would feel obligated to keep rates relatively elevated as a response to that, if nothing else, for public perception standpoint.
Do you expect the Fed cut to be implemented by June, which is what the markets are expecting?
I think so, probably June or July at this point. My guess is that the inflation data will be much closer to the 2.5% rate that they're looking for by June or July maybe. And so I think once they've seen that in the year over year, 12-month, inflation data, they'll have a harder time arguing that they need to keep rates as high as they are, for longer. And so I think they'll have an argument for at least, one or two cuts, maybe three this year. And that's the direction is more important to my mind than the level or how fast they go. If people are assuming there will be at least a couple of cuts this year, that's really what matters to the market and to the economy. The bond market, of course, is going to be volatile and kind of trying to figure it all out short term. But I think it's the fact that they're not going to be any more rate hikes and the next move will be lower is really what matters. That's what's mattered really since December.
Yeah. It's interesting how the Fed has not indicated any other shocks to the system that could potentially throw them off course. I'm talking about external shocks to the supply chain or perhaps even black swan events. Well, that by definition we can't predict black swans, but basically risks to the overall macroeconomic landscape that could significantly derail economic growth. Do you see any such risks on the horizon, Sam?
I mean, there's certainly, sort of external risks like, more uh, flare-ups in the Middle East, disruptions of oil supplies or things like that, or shipping globally, caused by, wars. I think the biggest domestic risk would be if fiscal policy suddenly goes into much more contractionary kind of a stance. If, things change in November politically, and there's a lot of deficit reduction talk and cutting back on spending and fiscal infrastructure kind of bills and things like that. That would be a longer term risk, I think, to the U.S. economy. Then there's the risk that just either Europe or China or one of the other major components of the global economy really hits the skids. They have talked a little bit about commercial real estate here in the U.S. being a risk. For the most part, I think the view is that that's not a systemic risk. It might be a risk for certain banks or certain companies, but not overall. And so I think the risks are things, yeah, like another pandemic, more major wars, or
Mhm.
major sort of policy mistakes, globally or in the U.S.
But basically, I think your base case view is that short of these um, systemic shocks, the economy would just continue growing on its own. There wouldn't be any significant slowdown from just from all else being equal.
Right. I think the general trajectory should be sort of moderate growth for
Right.
the U.S. With that kind of fiscal backdrop and the productivity and everything else that we've started to see, coming through in the data. I think the longer term, trends are there. And so it's just a matter of if something else, yeah, jumps in to kind of, to break it up.
Okay. In your reports, you've shown hypothetical model portfolio allocations. Can you summarize for us how you've uh, constructed these models? So here's a chart, for example, short-term risk model back test S&P and U.S. Treasuries, 60/40 benchmark return versus model equity return. Your model equity return has been significantly outperforming the 60/40 benchmark. How did you arrive at that model? Is my question.
Right. So that's what I call the global equity risk model, and it's something I've built years ago, and it's basically a composite of 8 different indicators to kind of
Hmm.
capture different elements of the market, looking at a sort of a 1 to 6 month view. So that's the kind of target forecasting range that I built it around, and so it uses a combination of in equity index price trend and momentum indicators, volatility, as well as credit from the debt markets, the Fed expectations, using treasury yields, commodity prices, and longer
Mm.
term real interest rates, all to kind of say, what is the backdrop and what is the current, price trends telling us about risk appetite, investor behavior, and kind of the interest rate backdrop. And those are indicators I found have been very useful individually for forecasting returns. And when you put them all together, that's actually is more reliable, more valuable than any single indicator would be on its own. So a lot of my work has some sort of a quantitative or a model indicator to kind of be an objective driver, meaning it's not just what I read in the paper or, kind of a qualitative, subjective view of everything, because it's very easy to get off track and get caught up in, whatever the current headlines are. I want something objective to kind of, keep me from going astray. And that model has been a particularly useful tool for that. And so it's been bullish for most of the last, 12 to 15 months. And it's solidly bullish right now, mostly because the trend is strong, volatility is low, credit is looking good, and Fed expectations are improving, meaning rate cuts are on the horizon. So those are all typically good signs for equities relative to bonds or cash.
Okay, interesting. And right now, we talked about the large caps versus the smalls. Are you still large cap biased right now?
Yes, yes. So I think large caps still have better trend, they have better earnings, and they also are kind of the phase of the cycle we're in is better for large caps than for small caps, at least until we start to see actual rate cuts coming from the Fed, and then maybe a pullback or correction in the market a little bit, to kind of shift investor appetite towards small caps. But I think it's rare to see small caps outperform on a sustained basis, unless you're kind of early in a cycle coming out of a low point, and we're not really there now.
Do you expect earnings to be negatively impacted should rates not fall anytime soon?
I think it will be, yeah, a process, kind of a growing process. But that's a good point in that large cap companies, particularly some of the very profitable large caps, higher interest rates may actually help them in terms of their earnings because they don't
Mm.
borrow much money and they borrow at low rates if they do. And they actually have a lot of cash on their balance sheet, which is earning more now. So, like, I think Apple probably makes more money with higher rates than it does with lower rates, or other companies like that, Microsoft or other companies. So, smaller mid cap companies, though, tend to have to borrow. They tend to have less cash and they have less access to financing. So they're much more impacted by the higher rates than the large cap companies would be. So I think if you do get a break in rates, that will help on a relative basis for the smaller companies. I don't think it's hurting the large companies that much, particularly the ones that have sort of underlying growth on their own, that have demand for their products. They can kind of ignore rates essentially. It doesn't make much difference one way or another. And so I don't think the big caps that are profitable will be hurt by rates staying where they are.
Yeah.
The economy might to some degree in the sense that mortgages and debt that was locked in earlier at lower rates will start to reset at higher rates, and that will kind of have an effect. But that'll be a slower moving thing. It'll take several years for that to really go through the system. It won't be all at once. So I think it can be managed, but I think it would be better if rates are a little bit lower later this year.
People have been talking about rising sovereign debt or federal debt in the US as a potential headwind to economic growth. And I'd just like you to comment on whether or not this theory has any merit whatsoever. So the US currently has a debt to GDP of roughly 120%, $34 trillion in debt. US GDP is also rising, though. Inflation adjusted GDP grew by 4.9% in the third quarter of 2023. The question is whether or not higher debt is of any concern and will weigh down on economic growth, given how growth has already been performing so far.
I would say the short answer to that question is no. It's not going to slow the economy. In fact, a certain level of deficit spending is required for the economy to grow. Obviously, it can be too high, but I don't think we're really at that in an extraordinary range now. I think people often misinterpret how to look at federal debt and federal spending relative to, say, the private sector. The Treasury debt and the federal debt isn't really debt in the same sense that it is for debt would be for you or I or for companies. It's the U.S. Treasury is the only source of new dollars. So if they stop doing that, then there would be no more money in the economy. So I think there's a misleading kind of assumption underneath that higher debt is bad because it has to be paid back and it's going to slow down in growth and all that kind of thing. That all applies for private sector, not for the U.S. federal government or other currency issuing governments. So it can be too high. It can also be too low. I think right now it's in kind of a decent range and probably should stay in that range if you want growth. Now there's what money is being spent and there's what it's being spent on. And I think people overlook that part of it too. If the money is being sort of invested wisely or spent on things that are good for the overall economic backdrop, then that'll be a better result than if it's spent on things that are not productive or useful. So there's kind of two sides of it, but I'm not worried at all about federal debt for the U.S. And I think that's been kind of a slightly misleading thing that a lot of even some of my clients have asked about that gets people worried when it really shouldn't.
Yes. All right. Finally, let's take a look at recent news regarding some equities. So tech stocks have been performing very well, for the exception of Tesla. Now, valuations, though, for a lot of these companies still remain high. If you take a look at just trailing PE, it seems that the markets have disregarded PEs and other valuation metrics altogether, because stocks have continuously gone up. Now, the question is whether or not you have place any weight on valuation metrics when you allocate capital to a model portfolio or a real portfolio. I mean, do PEs matter in today's environment?
They do, yes. I would say, you have to be careful in the sense that a PE will probably tell you very little about what's going to happen, say, next month or even the next 6 months. It might tell you a lot more about, say, the next year, 2 years, 3 years.
Yeah.
So if your time frame is looking to do what's going to happen in the short term, PEs probably aren't going to be very helpful because a stock can be expensive and stay expensive, for months or months. And so your timing, usually as a timing tool, is very difficult to do in the shorter term. If you have a long horizon, then it is much more useful. But you've had, a lot of examples of companies that looked like they were expensive and then their earnings actually went up a lot. And so they grew into their earnings or their PEs. Like Nvidia, of course, is a big example lately. It's actually less expensive now than it was a year or so ago, even though the stock has gone up so much on a forward PE basis, because the earnings are up even more. But I think overall, you want to look at valuations, from that standpoint, relative to the growth that the underlying earnings are showing, and also relative to, in terms of the overall market, what the alternatives are. I mean, relative to, say, bonds, or cash or whatever, the returns you could get or the valuations of other assets. And so for a while, the returns on bonds, 2 or 3 years ago were so low that stocks looked quite cheap, actually, when you compared them to the return available on bonds. Now bond yields are much higher than they were. And so it looks more like, kind of a fair value thing. Stocks are somewhat expensive, but, bonds are better yielding now. So, maybe they're sort of fair. But you have to kind of look at what the alternatives are. If you get out of stocks because they're expensive, what are you going to go into? And that's always the question of where else are you going to allocate that will give you a better return, even over the longer term. So I do look at valuations, but I look for the shorter term more at earnings trends and price trends than I do valuation. Valuation is kind of third on the list when I'm thinking about the next 3 to 6 months, typically.
Okay. I want to finish off on commercial real estate and banks. So here's an article from Reuters that came out earlier this month in February. Says fears about the health of the smaller banks have escalated again a year after the collapse of Silicon Valley Bank. Now, New York Community Bank Corp's NYCB's recent earnings release, which sparked a dive of about 60% in its shares, has particularly focused investors on combing through portfolios of regional banks. The small banks account for nearly 70% of all commercial real estate loans outstanding, according to research from Apollo. Now, the assumption is that commercial real estate is in danger or at risk. Certainly, delinquency rates on commercial real estate mortgage-backed securities are expected to rise, actually, according to some research. What is your take on regional banks and more specifically the ones exposed to commercial real estate? Are they at significant risk right now?
I think some of them still could be. I think some of that has already been, I think, kind of priced in, or people have analyzed some of those banks and kind of found where some of those bodies are buried in their balance sheet. So I think that last year there was big corrections in a lot of those banks, and of course a few of them went away. They got closed down. And so NYCB, bought some of the assets from some of those banks and turns out they were, even, worse maybe than expected. I think they're going to be those sort of, potential landmines for some of those banks at some times over the next year or two. I don't think it's going to be a systemic issue, but it will be an issue for certain banks at certain times. Now, the offset to that is the fact that banks, particularly smaller banks, in fact, more so than the large ones, have pretty good lending margins now. So if they make new loans relative to what they pay on deposits, they're actually quite profitable on those kind of things. They have some, profitability to work through that with. So their baseline lending is actually pretty profitable. It's the sort of old loans from before on the commercial real estate that they have to kind of work through. But as long as it doesn't all happen at once or be systemic, then it's just a kind of a smaller scale issue that the individual banks will have to deal with, rather than something that would be sort of across the whole economy.
Right. All right. Fantastic insights once again, Sam. Appreciate your thoughts. Where can we learn more about you and Mill Street Research?
Sure. So millstreetresearch.com is the website. I have a blog there that I update pretty often, and so you can sign up and get that for free. Just put in your email in the box. And then Twitter and LinkedIn, I post pretty often. You want to kind of see what I'm saying about current market events. And then the weekly roundup report that we discussed earlier is published weekly. It's $50 a month for if you want updates on the model that we discussed and macro commentary as well.
Yeah, fantastic. Thanks very much, Sam. I'll speak to you next time.
Thanks for having me on.
Thank you for watching. Don't forget to like and subscribe.